right, well, hello everyone and welcome to the Marketplace Risk virtual event series. My name is Andrea and I'm the Director of Events and Logistics here at Marketplace Risk. Today we welcome Brandy Mayfield with Aon and Peter Bousquet with Humn. Our virtual events are designed to help marketplace and sharing economy startups successfully navigate complex risk management, trust and safety, compliance, and legal subject matter so that they can avoid distractions in order to focus on launching and growing. Be sure to check out marketplacerisk.com to access hundreds of hours of content, including our master's program, platform, podcast, and previous events. And to subscribe to our newsletter where we keep you up to date on everything, including the upcoming Sharing Economy Global Summit in London. If you're interested in presenting at the summit or attending, feel free to email us, info@marketplacerisk.com. Thank you for tuning into today's session. A couple housekeeping items. First, this webinar is being recorded, so the recording will be available for you to access on our website. Second, all attendees have listening capabilities only and are otherwise muted. And third, do submit your questions via the control panel. If we have time at the end, we'll answer as many as we can. If we don't get to your questions, feel free to email us at info@marketplacerisk.com. We'll get your questions answered. And now, without further ado, presenters, over to you.
All right, thank you, Andrea. Good morning, good afternoon, good evening, everyone, depending on what time you're in. Pleased to be with you today. Brandy Mayfield here. I am the leader of the digital economy practice at Aon. I've been with the firm a little under 5 months, but have nearly 25 years experience on the commercial carrier side of the house. And I've built out a lot of insurability programs for sharing economy and digital economies. And my partner in crime today is Peter.
Good evening. So Peter Bousquet, I'm co-founder of Humn, based in London. Background, not in insurance, background in finance, but come to insurance through technology, data integration, and data science, and now we run an MGA here in the UK, supporting platforms as well as operators.
Perfect, thank you. And as much as we wanted to join you today and open up the magic 8-ball or crystal ball and just start listing company names that are in or out, unfortunately, it doesn't work that way. So under the lens of risk management heavily, but other operational considerations, we wanted to talk through what gig economies can do to succeed in the next few months to few years, depending on what's going on. And with that, we're going to hit across the variety of sharing economies, heavily vehicle, but there's also some taskers and home share, rental share in there as well. Mm-hmm. First thing that we wanted to go through was thinking about, the supply and demand chain. So what does it look like to optimize demand, given you know your cohorts, you know your clients today, but what does that look like in 3, 6, 12 months?
Absolutely.
And so,
I think a lot of the platforms that are more established, so the longest tooth are Airbnb and the kind of the rental share market, and then the rideshare market, and they've seen demand side shocks through COVID. So now this is a question. This is a discretionary spending shock. What are they expecting? And it's a very different change for them when you look at lockdowns. But ultimately, there's kind of two components that we're already seeing. So one is, people are much more cost conscious, suppliers, but then equally, there potentially is greater supply of both labor as well as availability of assets. And so you end up having to tune the way that you're communicating with those suppliers, and whether it be labor or space or rides, to their requirements. And and a lot of that is, you see this in messaging. So Turo recently did a new messaging in the UK, and then has done a couple of things in the US, where they're actually partnering with car finance companies. And so the messaging, it's co-marketing on car finance to say, well, if your vehicle is financed, we know that those bills now are biting more than they have before as rates go up. This is how much you could make if you put that vehicle on cover, and here's testimonials from people who have done that. And I think that that also suggests that the car finance company is aware that this is happening, and the insurance that is going to go alongside that is sufficient to enable or would not reject the supplier of that vehicle from that insurance were they to be found out placing it onto the platform. So, those kind of things, creating a cost-conscious message to keep supply where it is, or indeed increase supply, I think is certainly something that we started to see.
Absolutely. And as I think about what was profiled as generational a decade ago in interest in ownership versus not, that can be homes or vehicles, was it really generational, or was it, the effect of the economic downturn, and what is that going to look like again in a few years? So,
from a platform perspective, it's been called the millennial subsidy. So transforming venture capital into subsidized usership. Then the question is, what is actually the sustainable cost of delivering the platform, the user experience, and the asset into the users, into that contract? And that actually, I think, becomes a much bigger challenge. And you've seen the rideshare market mature. I don't think it's necessarily fully there yet. But how do you actually refine all of the elements of the profit and loss statement of the supplier to meet the requirements of the user in the moment, in a way that where the platform is no longer making that market happen through cash? And that becomes, and so what is that sustainable floor price to service the market?
Exactly. 4 years ago, I bought a vehicle, 2018, and last year I could have sold that vehicle as a used vehicle for $5,000 more than I purchased it. And so I'm keeping that vehicle. I'm not buying anything new right now. It actually only has 16,000 miles on it, given everything that's happened the last couple of years. But that being said, as that stabilizes and those prices for used assets or prices for homes begins to drop again, I believe the owners are going to consider how they can monetize and keep those assets versus selling at a premium like we're seeing today.
Yeah, and I think platforms have to compete with that, right? There's the proposition to the user. I suppose the premise that is always bandied about in the investor's office is, people don't need cars, they need transport. But the reality is, especially in the U.S., most people actually can't rely on kind of just-in-time transport because of the nature of kind of the commute and the work and you need transport to work. Thank you, Doug. Sorry, it's my co-founder delivering. Whereas in Europe it's very different, where the potential growth of usership is greater because the type of transport where a car is required is very different than transport to work on a daily basis. And so you've seen a growth in a slightly different experience, which is community car schemes, where you end up with a single asset owner who then has a very homogenized user group who then are using that asset in a sharing marketplace. And these are incredibly effective for homogenized user groups, and you wonder how that could potentially be magnified in this downturn. And where we've seen this is transport for key workers for hospitals, community car schemes for retirement communities, where, well, if the classic story of the used car salesman, she only used it to go to the shops on the weekend, or well, if that is the case, then that car is sufficient for 20 people, not one. And so, and that actually has been a tremendous growth market and mobility in Europe. So I think that this, if anything, in these downturns where CapEx budgets are cut, where the work, in order to sustain a workforce or to sustain a community, you have to look for alternatives. Providing this kind of solution to suit that can work, can actually create a growth opportunity.
Absolutely. As I was thinking about the homogenized user groups and a lot of perceptions around what a safe versus riskier user group might be, and I tend to think about everything from an insurability loss cost perspective, but there's a lot of risk management that occurs before you get to that loss happening or not.
Yes.
And so historically, we've anecdotally, strived towards understanding. Let's pick on the vehicle share space for a minute here. Are those vehicles going to be used for personal use, local distance versus long, considering commercial use, and then we get into the fun of vehicle share as a platform, and then whatever platform for that commercial use for gig workers as well. Longer distance travelers or minimum age limits that might be different than what you've expected in the past. Yeah. So there's a perceived riskiness with all of those. Do you think that it's going to occur the same way that it has in the past, or are there things that platforms can maybe do in this space to sort of overcome those hypotheses or historical experience?
Or the preconceptions, right?
Right.
Because the biggest challenge for the platform is proving the negative, and they're saying, well, we do the screening, the drivers are careful for these reasons. There's an alignment of best practice because of the ultimate user experience, and this is something that rideshare has been saying for a very long time, which is these drivers are more careful than drivers would be normally because of ratings, because of safety considerations. And I think that the insurance in general is looking for 3 years worth of data before they will begin to believe you. So how do you do that as a startup? And I think the two sides is it's going beyond screening, right? So you can always represent your screening, but then actually representing the deployment of those assets. And I think this is something that we spend a lot of time on at Humn, which is it's who matters a tremendous amount, but where and when, as far as predicting risk, is far more illustrative than how. So, when we look at, so we built, smarter people than I built an environmental risk model that predicts the frequency of accidents on any given road segment. And what we were able to then look at when we were predicting that was also how that vehicle was being driven when that accident occurred, when an accident was likely to occur. And the environmental factors actually are 2/3 of the predictive well, 2/3 of the predicted balance, and then 1/3 is how that vehicle is actually being driven. And so when you think about that from a marketplace, you've done the screening to say who is the person who's going to be using this, but then when and where, trying to reflect that to an actuarial standard, and then also manage and monitor that both in ghosting vehicles or ghosting assets when is not appropriate. And this is something that peer-to-peer vehicle sharing, micromobility is having to do. So bars are closing, all of a sudden there are no e-scooters in my environment. Well, that's very disappointing for me, the drunk who's trying to get home. The reality is they're just around the corner, but if I can't see them on my app, I'm not going to go hunting for them. And so those kind of things are the things that you kind of do the when. And then the where, that urban, you mentioned it, is this a long distance trip or is this urban? What is the predictive element of that booking? And you've seen this with both micromobility as well as rental sharing and other elements where that where is actually much more predictive about how that asset is going to be used. And the risk associated with it. So trying to kind of combine those and then also show active monitoring of that and then intervention becomes the way that you reduce the cost.
Exactly, as well as access to that factory whose second shift workers might still get access to scooters to make their way home.
make your way home, because you know that that is the low risk group that is actually doing what you need them to do. And what we found is that, and I'm sure you've seen this in your experience, that there is a way to do the when and where that is lower risk than would be imagined. And it's just about making sure that the who is the right cohort is sitting in those vehicles. And so, taxi drivers are generally safer than normal personal drivers because they're professionals. If you make sure that professionals are driving those vehicles, or professionals are using those assets, if you're actually doing an asset lend, then you should be in a much better situation. And if you think about like asset sharing, there's a number of platforms that are spinning up where it's not just vehicles, it's other things. How do you do that screening to find out what's the data source that allows you to show that this person has experience with that, with whether the vehicle or the device, and then that determines whether or not they're likely to damage it. And for rideshare and Uber drivers, when you're screening Uber drivers for insurance, it's not their rating that matters, it's the number of trips. So how do you do that in other markets? Showing, can you pull air miles to say that this is a professional traveler? Can you pull other data sources to then verify that this person is likely to be a repeat customer, and as a result, or a repeat user, and because of that, they're much less likely to do those kind of acts that cause loss and trust in the marketplace.
Absolutely. You actually just hit on something there, talking about the Uber driver profile. And that is platforms, depending on jurisdiction and regulatory requirements, might choose to procure insurance on behalf of all of their gig workers or providers for certain processes. And others might have the individuals procure that insurance instead. So thinking about the B2B of insurance versus the B2B2C, where it's not required, do you see any sort of preference or tendency to prioritize suppliers that are bringing their own insurance to the platform?
Yeah, I mean, well, what unlocks greater supply, and then I think the insurance as a profit center is very rare. So using it as a kind of thoroughfare to create additional fees, what you're really, I think in most circumstances, is trying to unlock better supply, and whether there is an economy of scale through the data that the platform holds that may be superior to the data that the individual supplier could represent. The one exception to that is where there's regulatory arbitrage in certain markets where the supplier of that asset may not be fully representing to the insurer how the asset is likely to be used. Which of course never happens. Of course, no one ever puts their house on Airbnb and notifies their home insurer that it's going to be on Airbnb. Of course they do that every time, but in those circumstances where they don't, there may be an arbitrage there. But that's not what you're talking about. I think the challenge, I mean, you know this, Brandy, the challenge is, what is that burden of proof at the point of the insurer? What's the strategic relationship between the platform and the insurer that potentially would allow them to lend credence in both cost and administration through a platform play that is superior to the directly delivered play? And I think that's the fundamental thing. So what is the integration? Can you do a finer grained toggle than you could with a directly purchased insurance contract? So the idea being the platform would have data about the actual unit of use of the asset of the location with greater fidelity than could be represented in a standard insurance contract. So episodic cover down to the minute, down to the mile, the meter, etc. But also incorporating that dynamic context of how, when, and where. They have that. Can you represent it in a way that actually shows exposure? and to a way that, and if you can, then there's tremendous savings to be had in optimization. Whereas the individual will not be able to represent that to their insurer in a way that the insurer would ever buy. And I think that becomes the opportunity, but it is a material challenge. And this is of course what you're there to do is finding the market that'd be willing to accept that story.
Exactly. And theoretically, who can capitalize versus the law of the averages? So there will be a cohort of owners, a cohort of drivers who are able to procure insurance at a better rate than those markets. All else being equal, you want to say that's going to be 50%, but likely not. It's going to be more like maybe 10 to 20%.
Yeah, it'll be a small quantity.
Yeah, it will be a small cohort, but procedurally, those should be the safer players for the platform. It's just a matter of finding the appropriate incentivization to figure that out, or managing it at the platform level.
But when you're communicating these stories to capacity, what are the key elements? Because I mean, that's the platform's going to come with data. They're going to say we have more data about our users than anybody else, and they should be right about that. But then what is that narrative? What are the kind of the key points that deliver that narrative that actually finds a home with the capacity?
Exactly. And in the last couple of years, a few platforms have a heavier supply versus demand. Other platforms have a significant demand versus supply. As those level back out, there's going to be prioritization processes on behalf of suppliers as well as on demand. What are your thoughts around some sort of gig provider, gig worker, gig user profile? We hear it talked about, and even in a couple of prior sessions here with Marketplace Risk, any kind of consortium to help screen out the bad actors. What are considerations for good actors?
Yeah, and well, I mean, in Europe, the ever-present element of the data controller just sits over my shoulder saying, "Don't say that. Can't do that." And I think the worker's passport, the worker's report card, I'm a good actor, therefore I receive a discount. Creating that incentive loop, it exists in some financial products. There's been loyalty schemes that have been delivered for a long time. Perhaps there's a way of building a product that creates that positive incentive, so someone willingly transmits their data. But that it has to be done in that way that actually creates a positive incentive loop, and then a value in the consent that they'll have to give to transfer the data, because there's a tremendous pressure in Europe on platforms looking at the rights of the workers, and then the responsibility with the data that the workers are actually generating for the platform themselves, as to how that's managed. And different markets are handling it in very, very different ways. And I think one example of the things that we're trying to do is, so we get asked this question all the time. So we work with operators, fleets, and the fleets or the brokers will say to us, "Oh, do they get to keep their data?" And you say, "Of course you can keep the data. We'll send them, all of their GPS coordinates for the last 24 months, and they can have that. That's fine, because that's really all we have." But then they say, "Well, do they get anything? Does it get like a certificate?" So we've worked with national authorities so that we transfer best practice to them. If they adopt policies and procedures, and they can put that seal on their website and say they have the National Highways seal on their website that they've adopted these procedures. How you do that for an individual gig worker to say, I'm checked, I'm screened, and I have a clean driving record. It's very, very difficult, and then there's just tremendous restrictions on even verification of representation. But one of the interesting ones, this is a kind of interesting one, is that one of the most illustrative underwriting points under private lines for screening is just lying in a web form. And so you don't have to, and so from a screening perspective, it's a fascinating one where if there's just one lie that you can draw out, and it can be really, really simple, like address checking, or what were some of the other examples? The color of the vehicle. I mean, there's really easy things to just verify. And if there's anything that's a misrepresentation, the likelihood that there's going to be a fraudulent claim or a problem goes up 2x. And so it's not, so it's those kind of screening things where you're like, well, what does the report card give me? The report card gives me a point of verification, so that if they come and represent all these things and there's not a match, I'm going to almost discard them just on that basis, rather than just taking the report card at face value.
Very fair and very interesting. We're hitting on supply quite a bit here. Let's go a little deeper on, maintaining and improving safety procedures for these platforms. And you actually have a case study with some information that I'd like for you to share with the group, if you don't mind.
Okay, yeah. So we work with this fleet. So let me just make sure that everybody can see the slides. Can you see that?
Yeah, we're good.
Okay, so we worked with this fleet. It's a taxi fleet that is based in Essex. If those of you are unfamiliar with the geography of the UK, it is the New Jersey of London. That's not saying anything bad about New Jersey, that's just the reality of it. And so they've been in operation for 40 years, and they have an operations manager who's been doing the job for 22 years. And you can imagine taking keys off a corkboard and throwing them at people. And the whole point is they've tried getting data from vehicles before, but it hasn't really worked. And what we wanted to work with them on, we provided them the data, but then the whole point is, how do you gather the data, and then what do you do with it? And so the first thing is you have to get good data in, so it's clean, it's structured, you can trust it. So easy onboarding of the assets, easy onboarding of the drivers, and then making sure that you actually can trust that what you're seeing is the reality on the road. So the vehicles that are parked in front of your office are indeed showed as parked and not driving on the platform. And that's kind of the base stakes. But the data itself, as you were saying, Brandy, doesn't actually, you have to tell the story and actually create knowledge that you can act on. And so the idea was, what are the key safety components and the key points that they have to raise with the drivers, and how do they do that? So making it very easy so that it's not running through spreadsheets and trying to understand graphs. It's saying, this is actually how you're doing today, this is where your concerns are, and these are your key risk factors. Is it vehicle control, or is it tired employees? But and these trends, these insights, then sort of empower the user to then take action, empower the platform, if it will, to engage with the user to take action. And so focusing on the riskiest drivers, or the best drivers, focusing on the riskiest customers, the best customer, to retain or manage. And so what she was able to do, with no increase in FTE, with no, she doesn't get more time on the day, was just focus based upon where the cost was really being borne. So what is that 20% where the real cost is, as to the 80% that are actually doing okay, and then also give context. And what she said time and time again was, the basic data wasn't enough. She had to have contextual conversations to say, this is when it happened, this is where it happened, and this is the trend, and focus on that single trend. And focus on the driver safety, the passenger safety, and then the reputation of the business and the reputation of the driver. And she did, no more outreach than she would have done normally, weekly check-ins, annual reports. But as a result of just having the data at her fingertips, and we know this from our own instrumentation of the platform, she does keep this tab open on her screen all day long. She was able to generate tremendous results. And so, for a business that has been doing the same business for 40 years, she's had the best loss ratio in the last 10. And, this is when you're talking about a better loss ratio than last year, where they did 40% less distance. And I think, the reason that we draw this out is that it's sort of illustrative in a simplistic way of what a platform or a trust manager or a safety manager, risk manager has to find a window into doing, which is the data in and of itself doesn't change the risk. If people know that they're being monitored, maybe they'll be more careful. But actually what you need to do is engage with the point of risk consistently and with very transparently to say, well, this is why we're engaging with you. This is what we are seeing. And if you do that successfully, you actually do engender better safety outcomes. And those safety outcomes have multiplied benefits. And that's the cost of the use of the asset, the direct cost of the insurance, and ultimately there you see a material improvement in the total P&L because you have higher asset availability, you have higher throughput of customers, and so and I think that's what marketplaces can do with the right partners, is deliver those kind of insights, whether it's to suppliers or to users. It doesn't have to be interventions. It's best to do them after the journey rather than before. But ultimately find a way of engaging where you change the mindset of what could be a customer or a user into someone who owns and understands the risk and the cost of the risk that they are exposing themselves to or the platform to. And then as a result, they become more diligent. And this, but it's an ongoing process. And the fascinating thing is you can watch these curves. And one of the things that we noticed, we called her up when she was on holiday and there was a peak and things had gone a little bit wild and she was away for 2 weeks. Because you have to, in this case, with 200 vehicles, you just have to have somebody who's reminding them that to be safe. But in a platform perspective, when you think about individual interactions, what is that loyalty message? What is the way that you remind them that, we're looking after your safety, and because we've seen you're safe, this is the value that you've created for us, and so we're going to share some of that value back with you. And then the same thing conversely with supply, you're looking after the assets, we're looking after the users, we're doing this to improve safety, this is what this means for you from a cost of delivering those assets. And I think that kind of positive loop then feeds into the result. But if it's not consistent and almost in perpetuity, it goes away very, very quickly.
Let's pick on that loyalty kind of in 2 layers here for a second. One is I'm seeing a lot of platforms and more platforms figuring out how to partner or monetize by way of some sort of subscription to loyalty or procedure on a monthly, et cetera, basis for customer stickiness. And I do see that persisting in the near future. The other is platforms know a lot about their users and suppliers that are repeat users and suppliers, and what that number of repetitions or time horizon can vary by platform. But what does the monitoring and response activity here do for us for new suppliers or new customers to help speed up understanding that consumer profile? I mean, can we get there 50% faster, or what does that look like?
Yeah, well, so our head of behavioral science, his PhD was on using telematics data to improve young drivers. So, in motor insurance, we know that young drivers cause just a vast proportion of motor accidents. And so what's the way that you take this data and then use it as training fodder to rapidly increase someone's familiarity and experience. So how do you reflect what's been observed back to the user in a way that they value that reflection, and then as a result improve the way that they're conducting themselves? And I think that then becomes that that kind of feedback loop, which is we have data, we know what good looks like, we know what you look like, we don't have a full profile of what you've done, but we can pick out these 4 or 5 points, and we're going to focus on one, and we're going to provide a kind of incentive loop based upon that one bit of conduct. And so in micromobility, it's the difference between the person who puts the helmet on and the person who doesn't. And so, what's the way that you do that nudge to just get the person to put wear a helmet? And how do you create that incentive loop, and how do you then demonstrate, that the platform is actually trying to confer not only an advantage to responsible loyalty, but then show what the benefits can be. And I think when we see this in rideshare, or you can even see this the way that some of the hosting companies are doing it, is how do you turn a normal host into a power host? How do you turn a normal driver into a power driver? How do you turn a first-time user into a multiple user? It's about showing what good usership can turn into, and that's you can speed it up with the data, provided that you create the right incentive loop. And so we just focus on variable pricing. Dynamic pricing is the way that we do it. And if you know that the risk is concentrated at the front end, there is a higher price, but careful usership reduces that price, and reduces it very, very quickly. An example would be in rental cars, your excess waiver, just offering for first-time repeat customers who have shown safe conduct, the fact that their excess waiver will be borne by the platform on the second bit of business. It confers loyalty where there's not a lot, and that can then engender continued use.
Certainly, and I won't mention speed governors for first or second time micromobility renters, or how people might try to race their friends that are more prevalent on the platform and can't win.
Well, yeah, I have a bad story. The speed governors, you had to take a quiz in order to remove the speed governor on one of the platforms, but they didn't turn the quiz off the mobile phone while you were using the micromobility asset, so you could be on the scooter taking the quiz. And the difference in speed was 8 to 13 miles an hour, which was a very big surprise when I passed the quiz while going 8 miles an hour. And I almost came off the back of the thing. So that's not necessarily the best way of doing that, but I won't mention the platform.
Certainly, nor whether you were wearing a helmet at the time. As we're talking a lot about risk here, but for companies to succeed and persist, we'd be remiss if we didn't talk about funding, IPOs, potential M&As, et cetera. So what should platforms be thinking about, or what is true for what we've built here in the digital economy that we might want to apply or apply differently over the next couple of years?
Yeah, it's unit economics, right? Where it was growth at any cost, now it's unit economics. Your stack has to make sense economically. And so that risk transfer, if you saying, I can externalize this, can you really in perpetuity at scale, or what are you actually internalizing? And if you're internalizing it to grow faster, what does that actually mean in the longer term? And the people who say, well, we'll just pay this premium, or we'll just pay these claims out of capital rather than getting insurance because we can't get insurance. What does that actually mean in the long term for you as a business when you're trying to run an asset-light, cash-generative platform? And that's the trap is, oh, I'm going to grow at any speed. That's fine. As a result, I can't get this kind of insurance as a platform. So we're just going to hold this cash in reserve and just pay away claims. Fine, but at scale, absolutely unsustainable. And I think that becomes the focus and the challenge that ultimately, you know, coming to you for, Brandy, which is who's going to take this, who's going to price this risk for me? I can't hold 100% of the risk capital on my balance sheet. And then also, you know, what's the right balance between passing that on to the user, passing that on to the supplier, and then owning the bit that I can afford to own, and that right price of risk transfer. So, and I think, you know, trying to be as transparent as possible so that the users and the suppliers value it. Because if it just happens behind the scenes, then you're just eating cost without anybody actually attributing a value to it within your platform as well.
And there's a benefit to the user experience that it's not that we lose it, but we don't recognize it when we're talking about risk here sometimes. So as we can pick across the spectrum of digital economies, but the reality is restaurants were running deliveries independently in the past, and they're looking more to the digital economies, gig economies to facilitate that now. You know, manufacturers, OEMs, hotels, et cetera, you know, other lodging facilities are looking to the experience and procedures that have been built up in platform economies to mirror, partner, et cetera, to bring back to their businesses. So as much as we can talk about capitalizing risk management to get the unit economics to work, what should platforms be thinking about relative to some standard economies that are looking and saying, hey, I know I've got to do this, or figure out a different technology than I've had in the past to keep my clients, keep my customers.
Well, keep your clients, and ultimately, I think the going from monoline to multi-line, you know, as from a product perspective, because if you do have that data, and that data is novel when compared to the traditional supplier of a similar service, what is the way that you then go back to that client with that loyalty scheme that actually delivers further revenue for your business outside of the primary line? And I think, you know, that's something that should be really the gift of the platform over the traditional business, just because of the nature of that interaction, the nature of the data capture over the use of the asset. And I think that still hasn't been, well, I mean, you know, the more mature providers of these services have begun to branch out, and you can start to see the potential with the, you know, the way that certain providers are moving from just asset use to experience, or you know, multiple products, you know, in marketing and other kind of corollary or other additional revenue streams from the customer, or indeed from the supplier. And I think that ultimately is the way that you get investors very, very excited, which is, oh, we have a business that's going to make us a margin, our unit economics are working, and oh, by the way, because we know our customer better than anybody else, these are the 4 other things that we are able to represent to them that they value and purchase.
Absolutely. Is there anything we should be thinking about with multi-unit economics?
Well, I mean, you know, buy or build, you know, partner or build. The biggest challenge with those kind of things is that you're also supposed to execute very cleanly on the first thing. And so going out and building 4 other things, it can be a confusing mess. So that's the challenge there. And then do you find somebody who's willing to represent within that your ecosystem, or do you end up having to do it yourself? And it's, you know, there's not many companies, especially now in the investment market where it is, where you can go out with a multi-pronged growth strategy and find investors who are willing to buy that. You know, you've got to be very, very focused. And so then it's, well, if you're going to add this additional branch to revenue, you know, you have to do it without taking too much risk. And that's the challenge there.
Cost of risk, fascinating. So kind of taking it full circle, we've hit the spectrum, but thinking about optimizing demand, maintaining or continuously improving safety mechanisms within to keep those risk costs down, and prioritizing quality supply, because in reality we all hypothesize there will be a higher propensity of suppliers here in the near future. Putting those all together, is there anything that you would want to add by way of non-risk monetization or non-risk pieces to either keep customers sticky or to help these platforms get an edge?
Yeah, but I mean, well, if you think about the goal of the marketplace is kind of creating a space where the two sides trust each other enough, and so I think it's that idea that the more you emphasize that sort of safety and risk management for both suppliers as well as users, that positive outcome, that the creating of that trust then both allows you to aggregate demand and also ensures that suppliers will stick around. And I think that becomes the sort of singular focus, because without that, if that erodes, it will dry very, very quickly. And I think that how you build that into the kind of the base interaction with both suppliers and users is critical.
Absolutely. I'm doing a quick time check here. We're getting a little bit close. Andrea, did you want us to open it up to any Q&A from the teams online?
That would be great. We have a couple of questions to start, and if anyone has any, please submit them via the control panel. First question, what should companies be thinking about with the right investment in tech?
Everything. Well, but most of these platforms came to be as tech companies that have really created the conduit between consumer and suppliers. So what future investment should look like is really a reflection of where they want to optimize the unit economics and where they want to partner with, if partnership is different than in the past.
Yeah.
So I think about a lot of what we build within the digital economy is optimizing tech to change process for something that has happened, for years. Pick your favorite pizza place. They were probably delivering 30, 40 years ago. Now they're still delivering, but they're doing it differently through partnerships. You think of your favorite hotel chain. They're probably on one of the big name platforms that we've already mentioned here. So is the investment in tech, for the consumer or for those partnerships to optimize what's going through the channel? That's what the platforms get to consider, in my opinion. Yeah. What do you think about it, Peter?
I always think that platforms are very, that sometimes they go data blind, in that they look at what they see, not what they could see. And so if you're going to invest in tech, if you're going to invest in a partnership, it's trying to figure out what is that data that you don't have that you could have, and how does that augment the value proposition. And so when we talk to rideshare platforms all the time, we're fascinated in what they don't see. They may see trip data, but they don't actually see accident frequency. They don't actually see unless somebody's making a complaint, unless somebody, driver injuries. They don't know. Gig workers are, in general, awful at going to the platform and saying, I've been injured on the job, because they are working 0-hour contracts. They need, this is not an easy job in any way, shape, or form. And so their goal is to get back working, not to make a claim. And so those kind of points of invisibility, then you say, well, what can I do to actually make that visible? And then what's the return I'm going to get from it? And how can I do that in a very, very cost-effective way? And that's the partnership bit, is who can I partner with to see that and then ultimately improve the user and supplier experience.
Great points. Others, Andrea?
Yeah, how should we be thinking about expanding risk management to other geographies?
Yeah, localization. You're global, Aon. Come on, Brandy.
Well, we are global Aon. You know, we joke around, not really joking sometimes, that across the U.S. you're really managing, you know, 51 different geographies and how you execute, heavily because of regulation, but also just what the appetite is for filed versus excess paper, et cetera. The same is true as you expand globally. You know, what is occupational accident in some places is workers' comp in others, and is personal accident in a third. And so as you're thinking about global expansion, it's really about having the right partners that know the nuances of the territories. I can tell you I'm no expert on some of the European, Asian, or Latin American countries. Got some friends that are. Likewise, there are some that, you know, I've worked in, but the other piece of it is knowing what is required from the platforms versus what is required on behalf of the individuals. And a lot of trends that I see here in the States are actually procedures that I've seen executed in Europe, you know, 10 to 20 years prior, not exactly with gig workers. The gig work is still a bit newer, but just the integrations of technology management into insurability. I look over the pond. So, Peter, is there anything that you think about with that?
Well, I think there's the kind of regulatory requirements, and then the market expectations. But I think also, you know, it's very when you think about engagement with customers, you know, telling somebody that you're watching their behavior is going to be responded to very differently if you're in the UK versus Germany. And so, you know, even the method of communicating the message that you're trying to deliver about safety is going to be viewed, you know, incredibly differently. And so there's a localization even on the engagement that I think is sometimes very much overlooked. And because it's overlooked, you know, people are like, well, why didn't this work? And you're like, well, because when you sent this email, this is what the reaction was. I'm like, oh, that's not what we would have thought it would have been. And so it's finding the right way of doing that market testing and research to ensure that what your base hypothesis of what is effective in communication and engagement is likely to succeed.
Absolutely. I mean, there are things that we don't think about or take for granted unless we've experienced them. So there are some geographies with high concentrations of individuals where only even odd days can you drive your vehicle depending on your license plate number. And so if you're thinking to go to market with supply and standards, et cetera, like you have in other geographies, that might not be possible to meet demand in those markets. So it's really understanding consumer response and requirements locally to make the full value chain work out.
Yeah, and you know, well, I was just in East Africa, and there were multiple driver apps, but the one that the drivers liked the best was the one that they could negotiate both on the app and in person, and then still get paid via card, because then they felt they got a fair rate. It was the same rate as the other platform, but the other platform just delivered that price without any negotiation. So even the supplier experience, the local requirements of trade, just what they expect to get a fair deal. You know, it's very, very nuanced, and I think yeah, you got to be on the ground. You got to talk to people, and you know, you can talk to Aon, and you've got people just about everywhere. So you'll find somebody for us to talk to and figure it out.
There you go. Yes, it's definitely a large firm. You probably know names I don't know just yet, but we'll figure it out.
We'll figure it out. You can triangulate.
Right. What else do we have out there?
That is all that I have for questions. If you guys want to give any closing remarks.
All right. We're getting close on time here. Thank you everyone for joining in. Obviously, Brandy and Peter, you can find us on LinkedIn or contact your Marketplace Risk for connections. Happy to talk about
individual. I think we'll both be at Marketplace Risk in London.
We will both see you at Marketplace Risk in London as well. If you've got questions on that, reach out to Andrea or anyone here.
Yeah, absolutely.
Awesome. Well, thank you everyone for joining us today. As a reminder, check out marketplacerisk.com to access this recording. along with hundreds of hours of content, and to subscribe to our email newsletter to stay up to date on all events. Thank you, everyone, and have a great day.
Thanks so much.
Thank you very much. Thank you very much for the questions, Brandy.
Have a good one.
See ya.